Right now, on these charts, where it's zone where institutions placed all were ordered. Most retail traders look straight through it. It's called an order block. And once you can see it, you'll never look at the chart at the same way. In this video, order blocks, what they actually are, why they form, exactly how to find them on any crypto chart, and the top one mistake that makes 90% of traders draw them completely wrong. An order block is the last candle or last group of candles before price make an aggressive explosive move in one direction. That's it. That's the core idea. Look at this. Price is consolidating here, 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 and after that, boom, explosive move up. This candle right here and this candle right here is an order block. It's created by the institutions to reaccumulate their positions after the impulsive movement, where we need to fulfill the FUG, which are formed after the impulsive movement, and grab to this area, and with the best price open deal, and after that go down. So this is an example, and after this we are going to the real chart, where I'm gonna show you all the order block examples on the real chart and how to work with them, how to trade with them. So let's begin. Here we can see two order blocks, bearish and bullish, from which we can enter a good deal. And it is the top three factors which are need to include in our analysis to make successful deals. So now let's begin. With a bullish order block. To make it more correctly, we need to make this like that and this candle like that, move with BOS. The first factor of forming an order block is a grabbing of liquidity. So it is not gonna look like that. It will have a candle which grab all the liquidity below to get a huge amount of liquidity for impulsive movement. So here's the price, grab all the liquidity, and after that formed an impulsive movement and thought it gave to us. In this case, we are waiting for the retest of this movement, because from the definition of order block, which I told you before, we are waiting the price return after grabbing this point. So how to mark the order block? We need to take the rectangle tool and place it from the highest point to the lowest. It doesn't matter in which way with the PVG it is matter. So we need to define this candle. This candle are order block, and from that we are waiting the action from the candles. So let's make it lower, because on the lower time frames, if you see, for example, on the 1 day time frame this formation, you can always place the rectangle tool on this candle wick to define the order block and go to the lower time frames, where you can see what this zone are order block 2. But in lower time frames it's look like a candle formation, but here we can see only wick, and so from which we can enter the deal right now. We need to take the long position tool, place it from the beginning of our rectangle, place the stop loss below the end of the wick, and after that place the order block on the grabbing of liquidity. But it is the risky way. We will place a take profit on the 50% of our FUG, for example, like here, and we can get a very good deal, but don't mention the risk reward ratio. It is a schematic. On the chart I'm going to show you the better deals. And another factor of forming the order block is impulsive movement, grabbing the liquidity, and the candle need to be eaten up by the previous candle, by the next candle. So the first candle we get like that, and the next candle are going to be like that. So it is consumption candle and have our order block formed, so from which we can enter a dip. So it is all, I think, what I can you to tell on this scheme, and here we can see the bullish order block which I showed you, and now we can place a bearish EG from this spot. So here we can see a candle which were consumed. After that the price retest our order block in this sideways movement, and after that the price turned to fulfill our FUG and order block, from which we already can enter a short position with stop loss, and take profit we can place here on the this FUG or on the grabbing of liquidity. To define the better take profit, we need to look at the chart. So bearish and bullish order block always work in the same way. So now let's move to the real chart. So now we are in the BTC high time frame, 1 day time frame, and can we see the order blocks here. So the first step, we need to define the impulsive moment. So we can see it here, but the candle which were below the forming of our impulsive movement didn't grab a huge amount of liquidity, which can cause a good factor of forming our order block, so we can skip this. Here we can see a big candle which formed order block on the low time frames, as I said before. So here we can see order block which I measured in the previous videos where I talk about Fiji. I don't remember. So here we can see the perfectly mentioned order block. Here we can see our candle, our wick of candle, and impulsive movement after that. On the lower time frames, it's showed as lower time frame order block, the consumption of the candle and the wick from which we can enter the deal, and of course price get the reaction from it. So here we can enter a very good long deal. And now I moved to the 4-hour time frame, and here we can see the order block which I measured on the 1-day time frame. So here we can see the big, huge amount of grabbing of liquidity, and after that good impulsive movement from which after that I can enter a very good deal. And of course here we can mention this wick which grab the liquidity on the left side of the chart. All the liquidity which are found here, here, and here, and after that the price gets a reaction from it. And of course we get an impulsive movement after forming this candle. So we can see the Masons. It's a secret organization which formed the movement on the chart, and from that we can enter the deal. So for example, we can see the mimic of order block, but this is the last candle after the impulsive movement didn't create the liquidity on the left side, and we can't enter from it. It doesn't grab this liquidity which I'm showing you. It's very good, very bad. And now we can see this candle which grabbed all the liquidity on the left side, and after that something big impulsive formed, and the price get the reaction from it. Let's mark it with another color and move to the 1-hour time frame and look what formed where. So here we can see the big candle which grabbed all the liquidity on the left side, and after that consumed by the other candles, and after that the price returned to this place to fill the PG which formed where, and grab all the liquidity here, and returned to the our fair value zone which I mentioned on the top. Of the best strategy to enter a good deal is a look for the liquidity zones which are grabbing by our instruments which I showed you here. Look for the Fiji to wait for the good entry zone. Order block is the helper to enter from the Fiji, and it is a formation which helped us to get a better risk-reward ratio in our deal. And of course Fiji helps us to define our good stop losses and take profit. Of course here we can see in our order block from which we can enter a deal all the formations of all the factors of formation of our order block are. And here is the grabbing of liquidity, the candle, and the consumption of this candle, and of course the forming of fair value gap from which we can enter. So it is not only order block. In this zone we have our PVG which are the best factor to enter a deal. So this is a zone where we can enter a deal, and if we are situated in this zone and waiting for the best time to enter the deal, we need to move to the lower frame and, for example, enter from this candle which are going to be the mitigation block. If you want to know more about the mitigation block, drop the like and I'm going to record the new video. So it is all examples of working of order block which I wanted to show you. Follow my Telegram channel where I'm gonna drop all the trading materials. Train yourself, do the backtest, and see you in the next videos.
You're not a trader, you're a gambler. The reason your account is sitting at zero isn't because you don't have a secret strategy. It's because you have the risk management of a Las Vegas tourist. You see a smart money setup, you get excited and you go all in. Wrong. In this video I'm going to tell you why this way of trading is not very good for your trading account. I'm going to show you the cold hard math what the big banks used to say rich while you are losing all your money. I'm going to show you why one bad trade can lose to you all your trading account. Look at this math. If you lose 10% of your account, you need an 11% gain to get back to break even. Easy, right? But if you lose 50% of your account because you were sure about the trade, you don't need 50% back. You need 100%. You have to double your money just to get back to where you started. This is the death spiral. While you are distracted by Trump's bam bam effect, tweets or war headlines in the Middle East, you are making emotional bets. The market doesn't care about your feelings, it cares about your position size. The solution is 1% rule. Here is the secret. Professional traders, the smart money, we don't think about how much we can win, we only think about how much we're allowed to lose. You never ever risk more than 1% of your total balance on a single trade. If you have $1,000, you are allowed to lose only 1%. It means $10 on one deal. But that's too slow, you say. No, that's how you stay in the game. Even if you hit a streak of 10 losses in a row, which happens to the best of us, you still have 90% of your trading account. You're still a predator. The guy risking 10% for trade is already extinct. I know what you are thinking. How do I calculate position size in 5 seconds while the market is moving? You don't do it in your head. I built a professional risk calculator. It's an Excel and Google sheet where you just plug in your balance and your stop losses, and it tells you exactly how many lots to buy. I use this for every single trade. I put in my Telegram channel for free. If you want to stop gambling and start trading like a machine, go to the pinned comment, click the link and download it right now. Don't take another trade without it. So now let's move to the real chart examples where I'm going to show you all secret strategies, how to calculate your risk management tool, how to use it in the live trading. So now let's move to the BTC trading and I'm going to show you what tool you need to use. And now here I can show you my best deals in my opinion. I read the market like a beast, very good successful trade from which you can entry and get a good risk management, and if you are risky enough you can get risk reward ratio. So now let's move to the previous movements and pick one which we can justify. So for example, for the good risk management we need a good entry point where we can place a good stop loss and good take profit from which we enter, from which we are calculated our risk management, and from which we are calculated our stop losses. So now let's look at this situation in which we can determine our fair value gap, our trading entry point, stop loss, and take profit. So here we are going to open a short deal because we have a downtrend movement which break our upside movement here and determines attached, I don't know how to say it in English, and here we can determine our fair value gap from which we can entry a very good deal. And about how to determine a fair value gap, I told you about this in previous videos. So we need to take this tool. I think you all know how to use it. L means long position, S short positions. So we want to enter a safety deal. Now I will show you several examples for how we can enter from FVG. For example, here we want to open a short deal. We are entering from the edge of the FVG to cut our risks, not to enter a deal. And we need two moments: take profits and stop losses. These are stop loss, these are take profit. So we need to determine our stop loss. We can place it in several ways. The pool of liquidity, for example here, here and here. But it is not a very good take stop loss in this situation because we can't get a good risk reward ratio, what we wanted to see in our trading. The risk reward ratio are showing us how much we can earn in this deal. For example, if we are risking 1% of deal, risk reward ratio 2, so we can win 2% while we are risking 1%. And the best way to enter a deal is when your risk reward ratio don't lower when free. It is a golden rule. So another way to place a stop loss is the end of our FVG. It is one of the best ways to place the stop loss, because if the price breaks our FVG zone, it is not more valid point of interest and point of entry. So we can place the take profit here. It is a safe way. It allows us to get a good risk profit, risk reward ratio, and risky way is to place it like that on the 50% or closer. So the lower our stop loss and highest our take profit, the risk reward correlate by these meanings. So we are going to place the safety, fair value gap, take profit, stop loss. And now we need to determine our take profit zone. So in this case, we are wanting to and aiming for the grabbing of liquidity, because the smart money moves only for liquidities, fair value gaps and order blocks. So it is our mastodons of our ideas. And we can see a huge fair value gap here, pool of liquidity here. And we can place the take profit here, because the price are going to grab that to get a new power for movement, because if these positions are not going to be grabbed, the smart money don't have enough power to move in our direction. So here we get a risk-reward ratio about 4. It is good, but the main question is how to calculate your size of entry. So you can use my calculated file in the Telegram channel, or you can use the trading view instrument. You just need to double click here, place your account size. Don't change these meanings, because it is only used when you are trading shares and bonds. So here we can place our risk. The golden rule is 1%, but if you are a risky trader and, for example, you has a low amount of your account size and you want to grow faster but more riskier, you can place 2%. Higher is for experienced trader, so 1 or 2%. And 2% means when the risk-reward ratio is 1 to 3. If you risk by 2%, you win 6%. So the main things is account size and risks. So that's all. When we place OK, we placed our deal, and here these instruments shows us on which quantity of cryptocurrency we need to open a deal. So if we opened a deal with leverage or no leverage, I don't know what cryptocurrency we are trading, we need to open by this quantity. But don't forget, if you have a low trading account, and if you are trading on 1 minute time frame or 5 minute time frame and use high leverage, you can be swept by stop loss, and it wouldn't close in your meanings. It can skip it. So here we can see what meanings so here we can see at what price we are going to set our stop loss, set our take profit, set our limit order, and wait. And the one important thing I want to mention in this video, you can and I can say you should fix your position size by size, and after you fix about 70 or 50% of your profit, you need to move your stop loss in the place where you begin the trade. So in this case you are 100% in a profit. For example, here you fixed your 50%, 30%, here you fixed your 50%, here you fixed your 70%, and here 100. Yes, of course, your end profit wouldn't be so much as you expected, but it is the most safest way to save your money. Don't forget about it. And now let's move to the one example which I wanted to show you. Here we can see the Fuji. A good Fuji, fake break of structure here, forming a pool of liquidities from which we can place our take profit. For example, we wanted to enter here, place a stop loss like here, not risky, not safety. But if we place the take profit like that of this pool of liquidity, we will get a risk-reward ratio about 1.5, and it is don't satisfy us. We don't need to enter deals like that, because when you win one deal, to lose all your profit by this percent risk, you need to lose 3 deals in a row, and you will be in 0 profit. You won't in minus, And in my Telegram channel, I'm going to drop the mathematical calculated sheet where I'm going to show you how much you need to lose and how much you need to win to get a very good profit. So the placing a good take profit and stop losses are the masterpiece. You need to practice that to determine where you want to place your stop loss, to place your take profit. For example, here you need to see the previous version of your chart, to see all data you need to use and place take profits on liquidity zones and VG zones. That's enough. You don't need other marks of entering a point. For example, here we has a risky deal because we don't have our confirmations of reversal of the price. Here we get a bad risk-reward ratio and we don't enter the deal like that. So I think I showed you all what I wanted to show about the risk-reward ratio. So follow my Telegram channel, from my YouTube channel, drop your likes and write comments about how to this video helped your trading account.
So hello everyone guys, and today we are going to talk about how to use Fibonacci retracement tool to increase your win rate, increase your profits, increase all your trading results. As a middle of this video, I will show you real examples of working strategy, easy working strategy for your trading plan. So now let's begin with the Fibonacci tool. You can find it here, looks like that. It shows us the meanings of correction of our market. But in the smart money concept, we use the Fibonacci retracement tool in different way. We use it for detecting our premium and discount market, and of course the optimal trading entry point. So in this video, I will teach you how to trade the sideways movement more effective, more profitable, and increase your results. So we need to see on the chart the impulsive movement, the beginning of impulsive movement, for example here, and after that the correction and formation of sideways movement. For example here, if the movement were bullish, we need to place the Fibonacci retracement tool from the highest point to the lowest. So now we are formed our sideways movement, we detected it, and what we are going to do after that. Here we can see on the top level of Fibonacci and on the bottom level of Fibonacci the liquidity pools, which price are gonna liquidate, we pause the liquidity, and after that reverse and break our sideways movement. And of course here we can see our FG or order block. Later I will show you on the real chart example how it will look, but here we have our point of interest zone from which we will enter the deal. So the most effective way to trade the sideways movement is waiting for the deviations and enter from the deviations. For example, the first case what can be the price can grab the liquidity here, but it is don't touch our point of interest zone and we don't want to enter from that because we lower our chances to get into a good deal. But after the deviation here, we don't open deals in situations like that because we don't have a good point to place our stop loss and price can easily liquidate you. So if the sideways movement formed after the impulsive bullish movement, we want to see the continue of impulsive movement, and for that we need the second deviation, and after that from our point of interest zone we will enter a good long deal on the capturing of liquidity of our previous high like that, and we get a good deal. So now I will show you why it works. So here we have our Fibonacci, and in smart money we can separate the Fibonacci tool by the premium and discount market. Discount market are situated on the lowest point after the meaning, so 0.5, because in this meaning the price are so low and the all traders, retail traders and institutional traders want to buy by this price, and after that, after the touching of this zone, the price are gonna up, and after the price get here about this means appears in the premium market where the price are too high to buy, and in this zone the price are gonna correct it with the Fibonacci tool lower. And of course the optimal trading entry point, I want you to see that it's situated between the meanings of 0.6 and 0.70 because it is the optimal trading entry point. So we need to see the zones in this case from which we can easily enter the trade, situating of the point of interest zone in the optimal trading entry. It is a good factor what you need to enter the deal, and you will get the win with higher chances. But in the sideways movement, it doesn't work like that because we only mark our sideways movement and premium and discount market. So now let's go to the chart and I will show you how it's for real. So here I defined our point of interest zone because it is order block. Here define our movement with the Fibonacci retracement tool. So here we have our impulsive movement down, and so here we have our highest point, here we have our lowest point. And at the beginning of this video I make a really bad mistake. If he has a bearish movement, you need to place the Fibonacci grid from the highest point to the lowest, and If we get uptrend movement, we need to place from the lowest point to the highest. So here we can see liquidity zones here and liquidity zones here. And what we need to see here, the price break our high, one Fuji forms there, and our order block formed here. The price doesn't update the lower low, so we don't see the breakout structure, the changing coin structure. So we need to define our liquidity zones here, and we need to define in what way we are going to open the deals. Here we have a great pools of liquidity. We remove them by this impulsive movement, and after that, of course, the price gets a little bit of correction, and after that we want to see the correction up with our optimal trading entry point, because here we have now Fuji, very strong Fuji, which I found is break our previous Fuji, and what deals we can enter in this situation. So we can wait for the price grabs our Fuji with a stop loss, other reasons, and the liquidity grab here. And another case of entering in this situation is waiting for the long positions after the capturing of liquidity, and with not very risky conservative stop loss, the take on the liquidity pool. So now let's see what will happen. So here we get into our deal. We need to replace this because we already this deal, and wait what will happen. Here we already can fix 50% of our deal because the price entered the premium zone where the discounts. Here we can fix our 70% and remove our stop loss to the zero loss point, and here we can fix our. And if you enter it from this Fuji, you can get a normal amount of money, because here we can fix 70% of your deal and remove the stop loss in the 0 loss point. But here we really were interested to enter a long deal because the great amount of liquidity accumulated here and the price break of its structure. So we move to the now example, and we need to define our premium discount zones and sideways movement. So we place it from the highest point to the lowest because we have a bearish movement, and after that we need to define our pools of liquidity, which are situated on the highest point of our Fibonacci retracement tool, and after that we are waiting for the deviations in this case, but after all we need to define our trend, because trend our best friend. And we can see what the price breaks there fire highs and don't update high lows, so we can see what the price are updated structure, and in this case we came open a long deal because the sideways movement formed, and after the capturing of with liquidity and coming to this order block zone, we can enter a very good deal with risky stop loss and good risk reward ratio of 5%. And after the price grabs our liquidity, we can see here the now order block zone of which we can enter, and after the first deviation here correction and another deviation, we can enter a very good deal on the grabbing lowest liquidity. Why we enter the deal here to the short? Because on the higher time frame the price update its higher low and changed the character to the downtrend movement. So thank you guys for watching. Don't forget to follow my Telegram channel where I'm gonna drop all the trading materials. You can see the link in the comments. Follow my channel, drop your likes, and goodbye. So hello everyone guys, if you ever bought at support only to watch the market crash straight through it, you are not alone. In fact, 90% of traders lose money at support and resistance levels. And today I'm going to show you exactly why and how smart money uses these levels to take your money. Stay until the end because I'll reveal where one pattern institutions never want you to know. So now let's go to the chart and define our support and resistance levels, and I will show you one example why it doesn't work like in trading book. Here I place a line on our support and resistance levels, and if you don't know how to define them, it's the lowest point and the highest point of the sideways movement or any other movement. Top level is resistance and support is the bottom level, because in the books the authors want you to believe what the price will jump from the support level. Don't let the price go down, and the resistance levels because it resists the price to go up, and in the books we will show the examples of the price are gonna always go down from the resistance levels and up from the support level. And now I will show you why it doesn't work like that on this simple example. And if we are going to look by the smart money logic, by the smart money concept, we want to see the stop losses and the liquidity what price are gonna grab. And in the smart money concept, the best way to place your stop losses and take profits, and the best way to place take profits in smart money concept is on the liquidity pools and our point of interest. So where here we can see liquidity zones what price in smart money concept are gonna grab. Yes, of course, on the support and resistance levels, because the retail traders place where stop losses near them, above them, behind them, and the price are gonna grab them to get the power for future movement. So here the price are near our support level, and the retail trader are gonna take a rectangle, define the zone like that, and here is gonna open a deal with short stop loss near the support level and take profit above here, because in his mind the price are gonna touch the resistance level and go down again. So here he gets a blue, and after that the price grab all liquidity on the left side and his deal are gonna be unsuccessful. And after that the price in smart money concept is grabs liquidity, gets the power money of retail traders, and after that it is gonna up after liquidity grab, and of course we have here after movement. So in this case, for example, you don't need to trade short on your open long positions, but from some point of interest zones, for example like that, for this Fuji, from this Fuji, and from this Fuji. And if the price don't get your entry point, you don't need to trade, because you need to work on your psychology. So now let's repeat again. Textbook trading says buy at support, sell at resistance. Sound easy, right? But where is the problem? Institutions know about thousands of retail traders are doing the exact same thing, and when too many people expect a bounce, guess what? The market breaks through instead. Support and resistance don't fail because we are fake. They fail because smart money is hunting liquidity. Most traders place where stop loss right under support or above the resistance. To smart money, that's like free cash sitting on the table. They push price just far enough to trigger your stop, grab liquidity, and then reverse back in the original direction. So now I'm going to show you how to trade support and resistance levels. So here we can see an impulsive movement which are formed, and in smart money logic here you can define a Fuji from which the price are gonna bounce and get a good growth. And now let's define the support and resistance levels. Here we have our resistance and here the support level. In smart money we don't define support and resistance levels, we only watch for liquidity grabs pool and of course discount and premium market. Here I measured them because I want to show you why it doesn't work again on the real chart example. So now let's think what non-trader are going to do. He will wait for the price coming for this zone, his support level, and after that he will open a position like that, is a stop loss here and take profit here, and let's watch what will happen. It can be one successful deal, but in the long distance it doesn't work like that. Okay, here he get a good deal, but our traders who trade by the same strategy here, we opened a short position which liquidated. No, we don't get their money. It's just a question of luck. If you're lucky enough, it will work for you, of course. But repeat again, in the long distance, it doesn't work like that. So what smart money traders are going to do? We have our Fiji, which we have mentioned before, and we can see what the price get a few times reaction from it and from our zones in this Fiji. And here the sideways movement are formed. We are going to define our premium and discount zone. I told you about that in the previous videos, and of course we have a trend movement. We are going to open a long deal. So here in the optimal trading entry point we have our zone of Fuji on the higher time frame, and we are going to open low position like that. Is a take profit here on the liquidity grab, and risk stop loss is a Fuji. We can make it more conservative, but we don't get enough risk reward ratio. And one more important thing, if the liquidity grab happened, doesn't count like liquidity pool in the future. Now it is on these weeks. So now let's watch what will happen. Here we get audio, and here a cursor. Successful one, but in this case, when the price get a liquidity win, we can move our take profit here and get a better amount of risk reward ratio, and of course it is give us a chance to get a more conservative stop loss. So now let's watch on this example. Next week has our support level, sorry, resistance level. Here support level. Here this meanings doesn't count. So what we can see here, the minor break of structure here to the downtrend movement, and we can expect the downtrend movement here. It is not gonna be so impulsive after the liquidity grab, or the price are gonna bounce from these meanings, but the global trend are bullish, and we are waiting for the entering uptrend movement. And we can see the Fuji here, what will help us to open the local view on the lower time frames. Fuji here, but I don't think the price are gonna touch them, and I think it's already touched. So the last zone we can see the order block forming, because after that the best way to trade in this situation, we can open from here after the grab of liquidity. But it is not such a good idea, because it don't has any good point of entry and a point of stop loss. And the good deal, I think, will open for this Fuji with conservative loss, with conservative stop loss of the liquidity grab, and take profit like that at all. Let's watch what will happen. So as I said before, we open the deal like that is not a very good idea. We're not gonna make like that, and the price not come to our point of entry zone, so it happens. Don't worry about that in your future tradings. And after the peak impulsive movement, we need to define our new support and resistance levels. For that, we are going to wait for the formations. For example, here we can get our liquidity grabs and the good entry point from here, and the best way to open the deal in this case is place the conservative stop loss like that and take profit here, but it has a bad risk reward ratio, so we need to move a little bit our deal. And don't forget to define premium and discount market, so our zone are the optimal trading entry point, and we are waiting for two movements: getting increased liquidity or getting increased liquidity. So the price get our deal, and here already we can fix our 50% and move our stop loss to the zero loss point, and we are already win this deal. So here we can fix our 80% of deal. So here already you need to fix the deal because it is too long and our formations are formed, and situations like that happens because you are too long with the deal and you need to fix by part on this means, on this means, and on this means. So I show you example. In this deal, if you fix by part, move your stop loss to the zero loss point, you are not going to lose money, you already earn a huge amount of money. And here the price grab all the liquidity down, and I think that we need to wait for the new formations here because we don't know how the trader gonna. So now we can see downtrend movement, local downtrend movement. We need to place our liquidity grab here. Here we can see another liquidity grab, and of course here. So the basic logic, the price will move for the liquidity grabs here, liquidity grabs here, and liquidity grabs here. It is fun. Now let's watch for the points from which we can open good deal. So here we can see a good order block because the price to reverse with minis, but it's already happened. And if we opened our deal area for the order block, the liquidity grabs happened, and here we already can fix 70% of our deal and move our stop loss to the 0 point. And here we have our successful deal. So the all liquidity grabbed here, and I think the price need to grab liquidity, and the movement reversed to the uptrend here. We can place our Fuji and the place deal like that because we want to see how the price grab all this liquidity. So the price don't get our deal, we don't get money here, but all our deals are successful here. So I watch you. So I showed you a best algorithm to trade support and resistance levels, but with a smart money concept here we trade liquidity grabs and sideways movement. Follow my Telegram channel, I'm gonna drop all the videos about this lesson, and goodbye.